At first glance, the US labor market still looks strong. Unemployment is low by historical standards, jobs are being added, and the participation rate remains elevated. But under the surface, something has changed. Cracks are spreading, and the underlying data is telling a very different story, one that hasn't made it into the headlines yet. In this video, I'll walk you through what's actually happening inside the US labor market. Understanding these subtle labor market shifts and what they mean about the business cycle sequence can help you determine where the overall economy is heading and how it will impact asset prices, interest rate policy, and potentially even your business situation. Over the past several years, the US labor market, especially among the 25 to 54-year-old prime age cohort, has been remarkably strong. Participation surged after the pandemic, job quality improved, and both employment and hours worked hit new highs. But now the data is signaling a clear inflection point. While headline numbers still look healthy, the momentum has shifted. We're past the peak, and early cracks are forming in both labor demand and job quality. Let's walk through 5 key ratios that reveal exactly where we are in the cycle and where we might be headed next. For these ratios, we're going to focus on the 25 to 54-year-old population, what's called the prime age population, because this removes the effect of an aging populace and other demographic changes. The first important indicator is the employment rate. That's the share of the labor force that's employed. This is simply the inverse of the unemployment rate, but we want to frame all indicators so that down means bad and up means good. The prime age employment rate has declined sharply from its cycle peak. This means there is more unemployment, but it's likely not coming from widespread layoffs. This metric usually starts to roll over early in the downturn as firms begin to slow hiring. So while broad layoffs haven't started yet, this early shift tells us that slack is quietly building. Next is the employment to population ratio, which measures employment relative to the entire prime age population, not just those in the labor force. This metric has also stalled and is now edging lower. That tells us that job creation is no longer outpacing population growth. It's a sign that the labor market is no longer absorbing workers at the rate that it once was. Growth has plateaued, even if job losses or layoffs haven't yet accelerated. Then we have the labor force participation rate. This surged in recent years as workers re-entered the workforce, but it too has flatlined, just shy of its cycle high. This means that prime age people are still engaged and workers haven't dropped out of the labor force, but employers aren't hiring at the same pace. So we're getting a mismatch: strong or at least stable labor supply, but weakening labor demand. Now we're going to dive even deeper into labor quality metrics, which is where the cracks in the labor market really start to become clear. When someone is working part-time for economic reasons, that means they actually want a full-time job, but they cannot find it. So we can look at the ratio of people who are working part-time for economic reasons as a percentage of all employed people. This part-time for economic reasons ratio, which is inverted in this chart, has fallen from the cycle peak. This means that an increasing share of the employed population is having trouble finding the full-time work that they want and have to settle for part-time work. A similar ratio, but slightly more broad, is the full-time employment ratio. This means the number of people working full-time as a share of the entire labor force. The full-time employment ratio is declining, which means a smaller share of the labor force is employed full-time. The ratio did reach its highest level ever in the pandemic boom as labor demand was intense, but that has clearly shifted and the signal is now clear. Employers are reducing labor intensity. This is classic late-cycle labor market dynamics. Faced with slowing revenue growth, margin pressure, or a deteriorating demand outlook, firms often reduce costs by slowing down on hiring or limiting hours, especially in roles that are easiest to scale. Instead of resorting immediately to layoffs, they shift to part-time work, delay backfilling roles, or scale back on full-time labor capacity, preserving operational flexibility while managing payroll expenses. One of the issues in this business cycle is that these late-cycle labor market dynamics have been present for almost 2 years. Normally, businesses cannot sustain this middle ground of throttling labor intensity without shifting to layoffs more quickly. So why are businesses doing this now, and how have they been able to sustain this middle ground for so long? When profit margins are strong, companies can afford to retain staff and absorb softening demand. Many firms saw profit margins explode post-COVID. Let's take an example from the residential construction sector. The average of the major US home builders saw profit margins explode from 10% before the pandemic to 19% at the peak. As the economy began to cool after 2022, those margins started to compress and fell back to around 15%, but still remain well above the pre COVID level. This extra margin cushion lets companies slow hiring or reduce hours without laying people off. It's a way to cut costs incrementally without disrupting operations or confidence. That's the phase that we're in now, not an outright recessionary labor market yet, but a clear and sustained shift in labor demand, labor intensity, and the pace of employment growth. Altogether, these five labor market metrics paint a consistent picture and one of a classic late cycle setup. The US labor market hasn't collapsed, but it's clearly past the peak. This is the quiet phase where hiring slows and firms reduce hours without cutting headcount. These are the cracks that form before widespread layoffs. If you understand these early labor market shifts, you can anticipate where the job market and the broader economy is heading. This is just one layer of what we track each week at EPB Research. If you found this analysis and this structured approach helpful, our premium research takes it even deeper with weekly reports, consistent frameworks, and a clear sequential map of the full business cycle sequence. Our goal is to help investors, management teams, and risk managers integrate this structured approach into their decision making, creating a situation to allocate capital and make forward-looking investment decisions with confidence. If you'd like to learn more about our research offerings and consulting services, click the link to visit epbresearch.com in the description box below. Please share this video with those you think would find it helpful and subscribe to this YouTube channel so you're alerted when the next video is released. I will see you in the next video.